Financial intelligence is more valuable than money, Robert. Kiyosaki. From the moment you first grasped that true wealth is not measured by the size of your bank account, but by the breadth of your financial understanding, everything shifts. Imagine standing at dawn in a quiet study, the sky pale pink beyond the window. You hold in your hands a single book, Robert Kiyosaki's classic promise that financial intelligence is more valuable than money. In that stillness, you realize knowledge is the seed, and money only the fruit. You begin by recalling the first time you heard about cash flow versus capital gains. It was a casual conversation at a networking event. A seasoned entrepreneur leaned in and said, "Money is easy. Keeping it and growing it takes real skill." You nodded, but only half believed. Today, you decide to learn that skill. You resolve to spend 1 year mastering the language of assets, liabilities, and the subtle differences between cash flow statements and profit and loss sheets. In week 1, you immerse yourself in definitions. An asset isn't your car or your house unless it truly puts money in your pocket. A liability isn't just your credit card debt, it's anything that drains money. You draw 2 columns on a whiteboard. In your office, assets on one side, liabilities on the other. You list your rental property, your small e-commerce site, your personal loan. You realize that some things you thought were assets have actually been liabilities for years. You erase them, humbled, and promise to build real assets by week 2. You encounter the concept of financial statements. You download your business's P&L and balance sheet. At first, the lines and numbers blur. But you lean in, line by line, guided by Kiyosaki's principle. Read every day. Learn the language of money. You write each term on a flashcard: EBITDA, depreciation, retained earnings, and quiz yourself during lunch breaks. With each correct answer, your confidence grows. In week 3, you dive into cash flow. You sketch a simple diagram: money coming in, money going out, and the gap that must remain positive. You map your own cash flow: revenue from sales, payments to suppliers, rent, payroll. You see a troubling dip at month's end. You decide to negotiate better payment terms with vendors: 60 days instead of 30. You propose net 45 terms to your customers instead of net 30. The changes are small, but the impact is immediate. More cushion in your account. Fewer nights spent worrying. Month 1 closes with a small victory. You negotiate a vendor contract that frees up $5,000 in your operating budget. Celebrate by reinvesting that money in a short online course on real estate finance. You feel the power of leverage, using knowledge to multiply. Results: in month 2, you confront your biggest misconception, that saving money is the same as generating wealth. You open your personal savings account and see the balance. It's higher than it's ever been, and yet you feel uneasy. You recall Kiyosaki's caution: cash under the mattress earns no return. You decide to redirect half of your savings into a low-cost index fund, and half into a small side venture you've been dreaming of, a niche consulting service for local startups. You draft a simple plan, set a website template, and reserve a business name by week 3 of month 2. The consulting service has its first client, a friend launching an artisanal bakery. For a modest fee, you craft a financial projection that helps her secure a small bank loan. Her success thrills you more than any bank balance ever did. You've transformed knowledge into value for her and for yourself. In month 3, you tackle debt. It's not all debt is bad, Kiyosaki reminds. Good debt can finance assets that produce cash flow. Bad debt simply drains. You list every loan you hold. The car loan at 4.5%, the credit card at 19%, the mortgage at 3.8%. You decide to pay off the high-interest credit card first, using a snowball method. Each payment feels like a blow struck against financial ignorance. With each balance reduction, you gain momentum and clarity. At the halfway point of month 3, you feel a shift in mindset. Money no longer scares you. It speaks a language you're beginning to understand. You network with a local real estate investor who invites you to a small syndicate meeting. There, you learn about passive income streams and the importance of tax strategy. You listen, take notes, and ask questions. Every question you ask cements your learning and expands your network. By the start of month 4, you've built a new habit. Weekly finance dates with yourself. Each Friday afternoon, you review your cash flow, rebalance your portfolio, and study one new concept like depreciation schedules or 1031 exchanges. You journal your insights. You adjust your plans. Slowly, your financial picture grows clearer. In month 5, you face temptation. A flashy gadget, an expensive weekend getaway, a tempting rental property that seems undervalued. You pause, recall the whiteboard assets versus liabilities exercise, and ask yourself, will this put money in my pocket? You walk away from the rental. It requires too much external management. You choose a shorter, modest vacation instead and return refreshed. Not overstressed, etc. Months 6 and 7 blend into a productive rhythm. Your consulting service nets to more clients. You attend webinars on stock options and on crowdfunding. You realize that diversification is not just picking different stocks, but varying asset classes stocks. Bonds, real estate, private ventures. You allocate small amounts into each, knowing that your knowledge will compound over time, just as your money will. In month 8, a crisis hits. A key client cancels a contract, cutting your monthly revenue by 10%. Panic threatens to derail you. But you remember Kiyosaki's mantra, the more you learn, the more you earn. You use the downtime to deepen your education. You enroll in a short workshop on negotiation tactics. You reach out to past contacts, offering a limited time discount for referrals. Within 2 weeks, you fill the gap and then some. You emerge stronger, having used your financial intelligence to adapt. Month 9 brings reflection. You schedule a full day away from the Office of Financial Retreat at a lodge by a quiet lake. You disconnect your devices, bring your notebook and books, and ponder, how much have you grown? What lessons have you learned? Who can you teach? You sketch out a framework of the 4 pillars of financial intelligence you've mastered: cash flow, management, debt strategy, investment, diversification, and continual learning. You decide to share these in a short ebook for your network. In month 10, you write that ebook. You pour stories from your whiteboard awakening in week 1 to your crisis in month 8 to a simple guide titled Financial Intelligence for Entrepreneurs. You design it yourself in a weekend using free templates. You launch it to your email list. Within days, dozens download it into readers' book consulting sessions. You feel the satisfaction of turning your journey into a tool that amplifies value for others. As you enter month 11, you reflect on relationships. Financial intelligence isn't solo work. You forge a mastermind group of 5 PRSIs at a different stage: a software founder, a restaurateur, an online educator, an e-commerce retailer, and a real estate agent. You meet bi-weekly, share challenges, insights, and opportunities. Each session refines your thinking and keeps you accountable. In month 12, you look back with amazement. A year ago, you tracked your assets and liabilities. Now, you hold a diverse portfolio, equity in a growing consulting business, shares in index funds, a slice of a rental property syndicate, and a small stake in a promising startup. Your cash flow is positive and predictable. Your debt is optimized. Your financial statements no longer intimidate you. You have built not just wealth, but the intelligence to steward that wealth for a lifetime. On the last day of your financial intelligence journey, you close your laptop, step outside, and feel the sun on your face. You understand that money by itself is fleeting. It can be lost in a downturn or squandered through ignorance. But financial intelligence, the skill of reading statements, negotiating terms, balancing risk, and learning continuously, becomes part of who you are. It compounds like interest, fuels every decision, opens doors to opportunities you once thought unreachable. Looking ahead, you ask yourself, what new horizons will you explore? Perhaps you'll launch an educational platform to teach these principles. Maybe you'll mentor young founders, guiding them to avoid the pitfalls you navigated. Or you might invest in social impact ventures that blend profit with purpose. Whatever the path, you know this truth, with financial intelligence as your foundation. Money will follow, and your impact will echo long after your balances change. Financial intelligence is more valuable than money because it is the key that unlocks the door to lasting prosperity. It transforms dollars into freedom, complexity into clarity, and dreams into reality. As Robert Kiyosaki taught you, knowledge isn't an expense, it's the greatest asset you can ever own. And once you own it, no market crash or interest hike can ever take it away.